let's talk about Cummins as well. The numbers came out and, they were, the company hopes to see a double-digit growth by the end of FY24. The margins were a beat. The revenues, though, were impacted a tad bit because of weaker export sales. But today we're, of course, going to talk about larger issues, which is the upcoming budget and what they can expect this time around. So we have the management joining on. Ashwath Ram, who's the managing director at Cummins, is with us. Mr. Ram, thanks a lot for joining in. This is expected to be an infra-led, capex-driven budget. If not now, then once the government, whichever government comes back to power. So from your industry and company standpoint, what are the key expectations? What would you need in order to boost your revenue growth?
Yeah, that's certainly correct that over the last 3 or 4 years, our company has been quite successful because of the continued spend in infrastructure. So as India aspires to become a 3 trillion and then a 5 trillion kind of economy, this cannot happen without a significant amount of expenditure in the building of roads, in the building of rail, metro. The entire power grid needs to be modernized, investments in new energy. So all of those kinds of areas are areas where companies like Cummins also stand to benefit. So we would like the government to continue this spend on infrastructure. Certainly the private capex is now slowly starting to creep up, and that is also going to help in the next few years. But the main investment that needs to continue without any slowdown is the investment in infrastructure. And we have seen that when countries like China or South Korea or even Thailand and Malaysia, when they did their spend on infrastructure, they didn't do it for 3 or 5 years. They continued it for a couple of decades. And that enabled them to set up a base for their economy to then keep building on. And that is what is required from the government to continue this growth in our GDP that we have seen for the last few years.
Extremely well argued, Mr. Ashwath Ram, that the capex thrust is not a matter of years, but decades. Specifically in the budget, is there something other than the capex number that you will watch out for? We just saw the government announce the reduction of duties on mobile components. In terms of tariffs, excise, any other policy measures, any expectations?
Certainly, we have an expectation that the FAME scheme, which is the incentive provided to launch products with new energy, things like electrification of buses, use of hydrogen fuel cells, etc., in mobility. I think the maturity of those products is going to take another almost a decade or so. Until then, the government needs to continue to incentivize some of those products so that investments are made in the country. The infrastructure for producing some of those components, etc., are created in the country. So we are looking forward to a FAME 3, and we look for hydrogen internal combustion engines as well as fuel cells in a larger proportion to be added in those schemes. Linked with that, we feel there needs to be some kind of GST subsidy for tighter emissions on fossil fuels, which means that India plans to become a zero carbon nation by 2070. Countries like the United States are going to be zero carbon by 2050. So but that is still 26 years away. So for 26 years, it's not that overnight one can switch to EVs or to hydrogen. There is a transition, and there needs to be incentives to help those companies which are making the air cleaner or reducing the pollutants in the system. I think it's a curve which the government needs to support. It's been doing that by accelerating the pace of BS6 and CPCB 4+, etc. It needs to continue on that path.
Yeah, I take your point entirely. They've already been giving green power a lot of encouragement, and actually we're doing reasonably well in renewable power across targets. But your point is taken that let us use GST and all these tax incentives to encourage. Just final question, very interesting, you whetted my appetite when you said that private capex also has begun. Where are you noticing it?
See, what we are seeing is utilization seems to have gone up. So which means all throughout COVID, where utilization dropped to something like 25, 30, 40%, we are seeing factories getting utilized at greater than 70% as of now. And so as you launch new products or you start investing in newer technologies or newer items that you bring to the market, the investments to support those areas have started to slowly start creeping up. So I would say industry is starting to invest in newer equipment and better equipment to produce the modern goods. But I think it still needs the government to continue its thrust to change the scale of the economy before we see significant more capex from the private side start to come in.
All right,
Fair
we'll leave it
point.
at that. Thanks a lot for joining us and appreciate your thoughts here on CNBC TV 18.